Welcome to the Techno Fundamental Report for October 26. Trend following. I first learned about trend following back in 1995. A good friend started to educate me on the concept, and I have been using it ever since. It's been a learning process. Now, the main thing about trend following is that if the trend of interest rates are up and if the trend of corporate profits are down, or the price of stocks is going down, it's like a train coming at you on a track. So, the logical thing to do would be to step off the track, let the train pass. In fact, in this picture, you can see a nice little sidewalk you could step off to. But point being is, if the train's coming at you, you got to step off the track and let the train pass and let the trends resume back to the upside. Now, when it comes to economics, John Maynard Keynes said here, he says, the difficulty lies not so much in developing new ideas as in escaping from the old ones. Well, that's kind of part of what a bear market is all about. It's the old ideas are dying off and the new ideas are coming in. But in Keynes's other quote I always thought was interesting, he said, in the long run, we're all dead. Keynesian economics was all about government spending and when it was appropriate and when it wasn't. And a good friend told me the other day that with what's going on today with our government, he must be rolling in his grave. Anyway, Peter Lynch, why you should always ignore economic predictions. Nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and concentrate on what's actually happening to the companies in which you've invested. In other words, trend following is important to understand. It's not predicting anything. It's just it's taking current trend and extrapolating from that. Now, I wanted to mention a little bit about what's going on with interest rates. Now, the Federal Reserve has, of course, a lot to do with this. Paul Volcker, we're going to look at some history here because I think really the only time in history that makes sense to observe at this point regarding interest rates is the 1970s. Our current chairman has said that he plans on following a similar route as Volcker in trying to deal with the inflation issue. So let's just look at history real quick. This is the 30-year Treasury bond going back to 1942. You can see here that interest rates started going up after World War II, and we pretty much stabilized around 8%. Now that's important because if you notice here, and we'll look a little bit closer at this, the stock market basically bottomed in 1974. It was the year of the bottom, and basically moved sideways and consolidated for an extended period of time. Even though interest rates jumped substantially, they went from basically 8% to 14.5%, which was a tremendous jump. Then once rates broke and started coming back down again, you can see that the stock market lifted off. Now, to take a closer look at it, this is where the market broke above 1,000 for the first time since 1968, and the rewards were quite remarkable because the market went into an 18-year bull market. It was basically an opportunity of a lifetime. Now, this cartoon is interesting. It says, buy low, sell high. I can't tell you how many times I'll be walking down the street or at a restaurant and someone will come up to me and say, buy low, sell high. And it's just a myth. It just doesn't make any sense. It's buy high, sell higher. The problem with buying low is that you don't know where low is. Now, take, for example, Target. This is Target recently. You could see that it started to drop. Okay, well, let's buy here because it's low. Got a little rally in there, then totally collapsed. Okay, well, let's buy it here because it's low. Got a little bit of rally, then it collapsed. Here's General Motors, same kind of story. You get the drop, okay, let's buy here, then you get another drop and another drop. You have to define a downtrend. A downtrend is where you make a high, then you make a low, then you make a lower high, then you make a lower low. That is a downtrend. Now, one thing about the market that you have to really somewhat buy into as a trend follower is the efficient market hypothesis. In other words, the market has all the information. So if you think you're smarter than the market, well, I wish you luck with that. The market has a way of having all the information, especially with the invention of the internet back in 95. The market became extremely efficient because the information just would get out so quickly. Now, let's take a look at these indexes because the market's telling us something here that we just need to pay attention to. This is the NASDAQ. Now, we're going to look at 5 indexes again. The trend meter up here, you can see what's going on with the trend meter. We've now moved into the red, which means downtrend. NASDAQ is in a downtrend, just made a fresh low, about to break below the 200-day moving average. Again, caution here would be important. Here's the mid caps, even worse. The mid caps are definitely in a downtrend. You can see the trend meter broke below, fresh low, another leg down for the mid caps. Here's the New York Stock Exchange, all the stocks on the New York Stock Exchange, again, downtrend, breaking to a fresh low. Here we have small caps. Now, this group's really been getting the roughest part of the deal. Made a high, made a lower high, made a lower low, downtrend is in the red on the trend meter. Here's the S&P 500, same story. We're in a downtrend, broke to a fresh low, actually breaking below the 200-day moving average for the first time in a good while. Now, interest rates are going to be important to pay attention to. We think this indicator makes a lot of sense. This is called the power index. Now, what I like about this indicator is it factors in time. Because if you really think about, what's going on here with interest rates, if they can just stabilize like they did back in 1974, if we can get a stabilization of interest rates, and you're going to see it here in the trend meter because over time, if rates just stop going up, it's going to fall off. And so what we're looking for here on this particular indicator is a downtrend in the indicator. Right now, it's an uptrend. You got a low, you got a higher high, higher low, higher high, higher low, higher high. Now we just made a low and we have not made a new high. So let's just keep an eye on this. I think interest rates are going to be critical to this process. Now on the aggression index, I did want to mention we broke down below the upper moving average. This is showing some deterioration, but this could change very quickly. But we would continue to be cautious and not aggressive. Now, on the 3 economic indicators, you can again see the uptrend in the 10-year Treasury note or Treasury bond. And then we have oil, which is somewhat breaking down, no longer really in an uptrend, starting to develop a downtrend. Also, the financial stocks continue to look weak. So, again, we would just simply say, keep your powder dry, keep a lot of cash on the sidelines, slow down on any new buying here. If you have any questions, please let me know.